You're listening to the ZABE Smart Mortgage Podcast, a podcast show that inspires and educates you about the lending process, what trends we're seeing, how to get the best rate, and so much more. Hosted by Fidel Dorado, team leader for the Fidel Dorado team at ZABE Mortgage Group. Fidel has helped hundreds of people with their mortgages, and now he wants to help you become mortgage smart.
Hey everyone, welcome to the ZABE Smart Mortgage Podcast. My name is Fidel Dorado with the Fidel Dorado team at ZABE Mortgage Group. And today we're going to talk about credit history, credit scores. What does credit mean? How does it affect your home loan? You know, what can you do to improve? What should you be looking at? You know, and things like that can hopefully bring you some good tools and some good insight as far as how to manage your credit. So what is credit? I mean, it's about the risk that the creditor is taking on, right? That's what credit basically is. And the way I explain it to my clients, the way I explain it to my customers is you have to understand is that what the credit bureaus do is that they're trying to monitor how much of a credit risk you are, right? One is, can you manage your credit or do you live off credit, right? So that's why you see sometimes when credit scores get impacted when you open up a new account, when you max out a credit card, for example, and different things like that, right? So basically, the higher the risk, the lower the score. The lower the score, the bigger impact it's going to have on negative impact it's going to have on your financing terms, whether it be a higher interest rate, a lower qualification amount, for example, credit limit, and different things or programs that you may not be eligible for to use, especially in the mortgage business when you're looking at down payment assistance or different programs like that. They can disqualify you having that lower credit score. So that you have to be a low risk, right, for the credit bureau, so in order for you to establish and build and have a higher credit score. So what does that mean is, for example, when you open up a new account, yes, I mean it dings your credit score a little bit, for example, right? Open up accounts, inquiries that you may have, hard inquiries that you may have, because in the eyes of the bureaus, right, when you're checking your credit, you need that credit for something. You might not have the money available to you, right, to be able to purchase or acquire what you're looking to purchase. So what happens is that, people apply. They open up a credit card. They might have a limit of, $300, $400, $500, $1,000, $5,000. And the idea is to be able to manage that, right? Credit is there as an option to a short-term option, is what it should be. When you're out there and you purchase and you apply for credit and you have a limit of $1,000 and you max out that credit card, you notice that it drops your credit score, right? At that point, you're a higher risk because in a way you're living off your credit. So what they do, and the reason why your credit score drops is that if you have a credit card, for example, with $1,000 limit, you max it out. What you're going to go do is open up another one, max it out. You're going to open up another one, max that one out, and eventually you're not going to be able to keep up with the payments. And if you're not able to keep up with the payments, it's going to cause a stress on you. And if you lose your job or something happens that it puts you in a hardship, you're not going to be able to afford it. That's going to be the first thing to go, right? Whether you go bankrupt or you just default on the loans that you have on your credit cards or whatever it may be. So in order to protect the creditors, what the bureaus do is that they impact your credit score in a negative way. They lower it, right? So the next time you apply for a credit card, the next time you apply for whatever it is that you're looking to obtain, it may qualify you for less. So first you may have a credit card that you apply for. It's a $5,000 limit. You max that one out. You apply for the next one. Your credit score is a little bit less. Now you're qualifying for it. So they're limiting you, basically, is what's going on, is that they're putting a cap and pretty much protecting their creditors. The less of a risk you are, like I mentioned, the higher the reward is going to be from the bureaus, right? And the higher credit score you have, the more options you're going to have available to you. Again, whether it be a lower interest rate or a better interest rate, higher credit terms, higher credit limits, maybe especially in the case of mortgage loans, programs that you may be eligible for, down payment assistance, lower mortgage insurance premium rates, better insurance rates. There's so many factors that come into having a good credit score that can benefit you not only in the short run, but also in the long run. Now, most clients usually have credit scores in, I would say, mid 600s, 680s, 700s. When it comes to mortgage purposes, it's just a minor tweak, right? It's just the way they're managing their credit. They may have a couple of credit cards that are very close to the limit. I always recommend maybe a 25% threshold, never exceed or carry a balance that's more than 25% of whatever your available credit limit is with revolving accounts. So, and of course, always pay on time. Some people, I've heard it before in the past where, in examples of late payments, where people would tell me, you know what, it's okay. I'll go ahead and send double the payment next month. So they'll skip one, have a 30-day late, but they don't realize how much of an impact it has on their credit score, right? So I always tell them, if they're asking you for $1, make that $1 payment. Don't wait till the next month and make a $2 payment. No, that's not the way it works. You have to be on time. You have to be responsible. But the most of the clients, like I said, it's just a minor tweak. If they're at a 640 credit score, for example, it's considered fair credit. They're eligible for FHA loans, conventional loans, different things like that. But the terms may not be the best, right? The interest rate might be a little bit higher. And in the case of down payment assistance programs, and right now in general, the credit score requirement for the different programs out there for down payment assistance is a 660. So it could be a minor tweak that you may need to do, and that's what we're there to provide that advice to maybe pay down this account, maybe pay off this account, maybe we have to correct a couple of errors that are reflected on the credit report that can help bring that credit score above at least to a 660 mark or higher. And now you maybe have better interest rate now, qualify for a little bit more because the interest rate's a little bit less. You have less debt now, for example. Now you may qualify for down payment assistance. So now instead of using all of your savings to use towards your down payment or towards your closing costs, now you have some reserves there available for furnishings down the road or unexpected costs, maybe some home improvements before you move in or while you move in, or maybe even paying off some debt so you can go into your new home debt free. So different things like that we encounter with buyers that we try to advise them on with credit. Now, when it comes to first-time home buyers and refinancing, the credit score is the same. It's always going to come down to the better the credit score, the better the terms, right? So even though as a first-time home buyer, for example, with an FHA loan, you may it might be more lenient towards people that have a lower credit scores and still be able to come in with a lower down payment. With the refinance, I think it's better to have at least a 700 credit score. But there's so many factors that come into that. For example, the loan to value on a refinance impacts the interest rate, obviously the credit score, the type of refinance, whether it's going to be a cash out, no cash out. Are we doing, does it have an impound account? Is it not going to have an impound account? So there are different factors that do impact. I feel it may impact more of on the refinance than it would on a purchase side of it, especially for first-time home buyers. Some of the things that I talk about, especially and you'll see in our website in the video, is when we ask, are you really ready to purchase? We talk about credit, and people usually have the fear, right? Or in a way, an excuse, right, of what not to apply or reasons not to apply yet. And one of them is credit. I usually hear quite a bit about, what, Fidel, I do want to work on some things before I do apply. And the question is, well, how do you know what things to work on, right? That's the tough part. And without knowing what exactly you need to identify and what you need to work on and correct, then you may be working on something and you feel that you're ready. You come in to apply a couple months later and you're not ready. You didn't take care of the things that you really did need to take care of that were going to have the most impact on your credit and improving your credit. So those are the kind of things that we always encourage clients to just come in. It doesn't hurt. Just find out where you're at, get the proper advice as far as which accounts you need to identify and take care of. You hear about credit repairs and you hear about disputing accounts and different things different programs have different guidelines for disputed accounts and they may not allow for them. They may be required to be resolved, right? A resolution with the dispute. Is it something that the consumer agrees with or disagrees with, I mean, they have to be resolved with certain loan programs. So overall, as far as credit scores, as far as how you build and how to get your credit score, history is a big factor, right? How long have you had your credit? How farther away are you from having any kind of derogatory accounts, right? If you had a late payment in the last 3 to 6 months, it's going to have a great impact on your credit score. The further you distance yourself from that late payment, the better, right? Especially if you can have other accounts that you are building on and are reestablishing your credit with. I mean, that's obviously going to help improve it, but it's going to take time. It's going to take discipline, right? It's going to take an understanding of how to manage your credit versus living off your credit. And the question is, I get this a lot too, is, well, how do I get to a 700 score? How do I get to 720? I'm at a 616. I seem to always be staying within that range. Well, it could be a lot of factors. It could be, basically the way you're managing it. How many accounts do you have open that are revolving? How many accounts do you have open that are installment accounts? Balance versus credit limit ratios. Those are factors. And of course, the history. So overall history, the length of time that you've had credit available to you, managing the revolving accounts. And revolving accounts basically are credit cards, right? Think of like a revolving door, right? You go in, you go out, in and out, right, with the revolving door. Credit cards, revolving accounts, you use them, pay them down, pay them off, use them, pay them up, things like that. Installment accounts are basically accounts that are closed end. Think of an auto loan where you have a set term of what you're paying. And once you reach that term and you've fulfilled your obligation for that term, it's a closed account, right? You're not going to go back, and you can't go back and use it again, right? You have to apply for a whole new loan. Having a good balance between those type of accounts, installment and revolving accounts, is always wise. It's always good. But most importantly is being able to show that you know how to manage and that you're disciplined in using your credit, being on time, and building that history over time is what's going to help you build your credit score. When it comes to credit repair companies, it's a great question because you do have some good credit repair companies out there. I have yet to develop a relationship with a credit repair company. What I like to do is I like to give the advice myself directly as far as how to understand credit and how to build it, how to manage it, right? So obviously there is credit repair companies out there that do a great job of finding errors, right? Finding understanding the laws of what it takes with collections, for example, how to dispute them, how to get them removed. That can help remove some of these derogatories from your accounts. Credit repair companies, they're there for a reason. They do offer a lot of services, but to be honest, I'm not a big believer in referring or utilizing credit repair companies, to be honest with you. The bottom line, the takeaway that we have from credit and how it relates to mortgage loans or just in general is that understanding how to manage your credit and what it's there for. It's not there to live off of. It's not, and it's there really to use as a resource to bridge a gap, right? Obviously, not all of us have $100,000, $200,000 sitting around to go and be able to purchase a house, or $30,000, $40,000, $50,000 to go and purchase a car. But understanding that credit, it's a responsibility that you must have, and show that you are not of risk, right, to the creditors, and it's a show of character as well, right? So being able to manage your credit, being able to keep low balances, being able to deliver on your promise that you are going to repay is key. And that's going to reward you with the higher credit score, right? And with the higher credit score, it's going to reward you with better terms, more opportunities, better credit limits, right? Overall, it just reflects well at the end of the day, right? It's a prideful thing, right? To have good credit, to walk around and say, hey, my credit score is in the 700s, and that's an awesome feeling, or know that you're fulfilling your obligations. In our country, we do have that instant gratification, right? We want something and we want to get it then and there, versus maybe trying to build up, save towards that, right? And it's not to say, for example, oh man, well, how much is that? And I'm never going to afford that. You got to be able to say, hey, you know what? Well, what is it going to take for me to get there? How long do I have to save for, and how much do I have to save to be able to do that? So there are things that, do we really need them? Do we really need to put that on credit and pay 20, 25%? Does it really bring value to me? Is it value to me, or is it just something that I just want now because I just got to have it, for whatever reason? But, I read a stat the other day that 47% of homes are mortgage free in our country. Kind of surprising, right? So 47% to me is a lot higher than what I expected, but that's pretty impressive. That's pretty good. So at least when it comes down to mortgages, almost 50% are homes are mortgage free. So that was a pleasant surprise to see. Now, as far as revolving credit cards, yeah, we do have, seems a slight problem with that. And again, it comes down to the instant gratification. More so now that we start seeing the social media and the things like that. From what I see, is the showing off of, I did this, I did that, or I went here, I went there, and putting on credit cards instead of being able to show the patience and the ability to save and budget to be able to accomplish those things. The biggest thing that I love to see is our young ones, right? Fresh out of school, fresh out of high school, college, or whatever it may be, coming in and asking about credit. From what I remember, I mean, it's been several years out of high school, and especially out in high school, and I don't know in college, I never went to college, but from what I understand, there really isn't any kind of courses or classes that teach you about credit and how to manage, how to establish, how to build credit. And so it's a breath of fresh air to see, especially a lot of the young ones, even people that are under 18, that come with their parents and just to sit in and listen or help, translate or whatever it may be when they come with their families, and to listen to what it takes to build credit and what it means. And, and I've seen lately over the last couple of years of the younger generation that I've met with, is I'm starting to see them manage their credit the way it should be. One or two accounts, credit scores in the low 700s, maybe because the history is not there. But I see that they are taking an interest and are taking, the importance on that as far as establishing and maintaining good credit. So it's good to see that. So here as a mortgage group, what we do is, we'd like to give advice, right? Even though sometimes it may not be what you want to hear, right? But we're here to tell you what you need to hear, right? If there's some things that we need to work on with your credit, we're not here to judge you or do any of that kind of stuff. So, and that's what I always tell clients: just come in. We're not gonna spank you. We're not gonna do anything like that for having, some derogatory marks on your credit or having a low credit score or anything like that. It's just about having an idea of where you're at, where you stand now. You may have good credit, but you may be one tier below where you can get better financial terms. So you might have a 720 credit score, but what if we can get you to a 730 or a 740, right? So, we're here to advise you, every step of the way, as far as credit and what items you may need to take care of, pay down, pay off, accounts that you are there, with as far as an error that we need to fix. So we're there as a resource to make sure that we provide you the proper tools and proper understanding of credit so you can help build, reestablish, or maintain.
This has been an episode of the ZABE Smart Mortgage Podcast. Whether you're a first-time home buyer, purchasing your next home, or refinancing, being smart about your mortgage options will save you time and money. ZABE Mortgage Group connects you to the technology, resources, and education to make you mortgage smart. From pre-approval to applying to getting approved and managing your loan, visit zabemortgage.com.